So to begin with, we've had an introduction of you, but these are things that most of the people know. Uh, Tell us a little something about your investment philosophy or the moments that shaped your investment philosophies or the people who shaped them. Uh, just to start the conversation and allow the people to know both of you better. Chirag, you goes first.
So let me start first by thanking Dezerv for giving us the opportunity to talk to you today, and thank you, Pratik, for hosting it. We've been doing this for now 25 years, and in a sense, investment philosophy, while it does change, has fundamentally remained the same, which is, as you pointed out earlier, you want to buy high quality businesses or good quality businesses. You want to hold them for the long term, and you want to invest in them, especially when they go through difficult times. So you want patience, you want good quality businesses, you want a long term perspective. Now, if you put 10 fund managers on the stage, all 10 will give you the same answer, that you want to buy good quality, you want to pay reasonable prices, you want to hold for the long term. So the answers don't vary much, right? The answers that everybody has will remain the same across 10 different fund managers. Somebody will be okay to pay a little bit more, somebody will have a shorter term time horizon. But the key in our business really is about discipline, right? So you want to buy high quality businesses, and every once in a while you encounter a business where the story seems very exciting, but the business is not as good quality, and you get tempted to buy it. You want to invest for the long term, but very often you come across a short term opportunity and you feel tempted to buy into it. You want to buy companies at sensible valuations, but you are tempted at both ends of the spectrum. You get companies which are doing fantastically but are very, very expensive, but you tend to get excited by the fact that they're doing very well and you want to buy them. And you get tempted by businesses which are poor quality and dirt cheap. And then again, you tend to make a mistake. So, what to do in our business is known to everybody. Buy good businesses, hold for the long term, don't overpay, buy into adverse conditions. But the key is to have that discipline, not to get tempted by things which lead you astray. So I think our philosophy has always been to be stock specific, research oriented, long term in our orientation, and to have that discipline, to create an atmosphere, to create a culture which encourages discipline, which doesn't reward short term behavior, which rewards the right things. And that's an evolving process. But I think in a nutshell, that's how we think of it.
Excellent. Thanks, Chirag. Taher.
Hello, good evening, everybody, and thank you, Dezerv, for having me here. Happy to be here on this forum, and thank you all the Punekers for coming over. Well, I think Chirag probably has said it all, and he's also said this, that, managers are probably not going to have a different starting point. I think all of us are probably tied to the same agenda of essentially ensuring that we give quality returns to investors. I think for us, I'm sure I speak on Chirag's behalf as well here, that we are managers of public money. We are not exactly managers of proprietary money at our end. And I think that calls for something more than, the characteristics that Chirag outlined, which is basically that I think and this is the philosophy that I think we have probably lived by in my last few stints, and throughout by and large my career in the investment field, is that we need to do the things in a process oriented manner. I think that's something which is very important, because there needs to be a certain discipline and there needs to be a certain way of doing things. We all have our own individual brilliance which comes along the way, and that's something which will always be there. But I think we are managers of public money. We have that fiduciary responsibility to all of you, and it is important that we do things in a manner which are transparent, and where you at your end can understand in a transparent manner as to how we are going to conduct our affairs on a day-to-day basis. Markets can be random. While there is science behind it, there is also the importance of temperament, and psychology also plays an important role, as we all know. So I think we need to be grounded from that perspective. And therefore, my philosophy, at least at an individual level, is to make sure that we have a good, well-tested process that we an investment philosophy that has been laid out, and then try and bring in that discipline and superimpose whatever individual skills that you can bring to the table in order to generate returns, such that there is always an element of continuity. That whenever anything needs to be handed over next to the next uh, manager at in due course of time, the investor should not feel that anything has been compromised. He should feel the continuity in the approach and the methodology which with which the funds are being run. So I think that is the underlying overarching philosophy on the basis of which uh, I conduct myself, and we ensure as a firm that we are able to deliver.
Thanks, Taher, for that. Moving on, both of you are fundamental managers, obviously focused on the long term. Talking about long term, Niti Aayog has set an ambitious target by 2047, $30 trillion dollars of economy. And from where we stand today, do you think it is achievable, Tahir?
Well, yeah, I mean, obviously we are a growing economy, and we all know that a lot of stuff across many sectors, across many industries, is still quite underpenetrated. So we have the journey to cover. I think the best way to probably look at it is that even a $30 trillion economy like the US today is probably growing quite well under the circumstances. And corporate earnings there are growing at decent double digits. At this stage, perhaps a notch faster than even India is growing. So I think if economies like those at that scale, that size, that level of maturity can probably grow even today, I think India obviously has a lot more to do. But obviously, it's not going to be easy. There are several challenges, and there are many gaps that need to be filled in order to make sure that we get to that. So it's not going to be we are just not going to be able to just close our eyes and see that we from here will magically transport ourselves from being a $4.5 trillion economy to being a $30 trillion economy. A lot of work needs to be done along the way. But I think we have the basic elements. There are many more which we need to put into place. But clearly, it's possible, and I would say it's that is what we are all living with as not just a distant hope, but something which we can concretely achieve over the coming years.
Sure. Chirag, 9.5% CAGR possible.
So, I'm always careful of new nomenclatures, right? Viksit Bharat, Atmanirbhar Bharat, and so on, right? And politicians and governments are very adept at creating phrases and catchwords which catch the attention of the public. Keep in mind that India has grown at 11% for the last 40 years, not the last 5 years, not the last 10 years, but for the last 40 years. In those 40 years, we have faced innumerable challenges, right? We've had a global financial crisis, we've had currency crisis, we've had, COVID, we've had so many crises thrown at us. Despite all of those, roughly 6% real GDP growth, 5% inflation, we have grown at this number of 11%. There is no reason to believe that we cannot grow at a similar pace for the next not just 5 years, 10 years, 15 years, and even longer. The challenge is to increase this 11% to 12% and 13% and 14%. And I think that is very hard to do. And you need to do a lot of structural reforms from an economic standpoint to get there. And I don't think those are easy political decisions to make, whether it is from a regulation standpoint or a labor standpoint. But the good news is 10, 11% for a country like India is very much achievable. And 10, 11% growth for an economy can translate into 13, 15% earnings growth from a corporate standpoint, which means if you are invested in equities for a long period of time, you'll do extremely well. The key to investing, if I had to use one simple line for the key to investing, it is about longevity. The longer you invest, the better. It is not about which fund you choose, fund house, mid cap, small cap, large cap. So in a country like India, which is growing at 10, 11%, if you invest for a extended period of time, you'll do very well. So I won't worry about the nomenclatures. I think India's growth story has been strong, continues to be strong. We'll have a few hiccups along the way, but I think that 10, 11% is certainly achievable. More than that is difficult.
Thanks. But Chirag, as you said, that while we've seen a lot of problems already, as big as COVID or maybe a GFC, every time, at every point in time, investor is still confused whether this time is it different. So right now, the biggest concerns on people's mind is tariffs. Artificial intelligence, will it disrupt the Indian IT industry and hence the Indian consumption story? Uh, and obviously the geopolitics that's playing around. What's on your view on that? How do you still stay bullish in such a scenario? And if yes, how? If you can help us with some tips there.
So, it's interesting. We have a presentation which talks about the global economy, stock market, how to invest, and so on. And one of the slides that we have in our presentation is a slide on risk factors. It is the one slide which changes dramatically every 3 years. The risks of today, as pointed out, was there is a risk of the US economy, there is a risk of AI. The one thing, I don't know how this is going to play out. If I was that smart, I wouldn't be sitting here, right? I'd be worth billions and billions and trillions of dollars. The one thing I can guarantee you is the next set of risks will be dramatically different. 3 years ago, we were obsessed with COVID. 10 years ago, we were obsessed with what was happening in Europe and the European crisis. And 12 years ago, we were obsessed with the US slowdown and quantitative easing and so on and so forth. So the risks are always going to be there. It is part and parcel of investing in equities. You are never ever going to find an environment where there is no risk. If you believe there is no risk, you are not understanding the risk. There is always going to be risk. You have to live with the risk and you have to ask yourself, how am I going to deal with it? If the risk pans out more adversely than you anticipate, what does that mean? The risk pans out, as an example, in this specific example, US were to slow down, markets were to correct, markets were to collapse. How do you react to that environment? The risks are always going to be there. Are you going to sit on the sidelines and do nothing? Or are you going to invest more money into a difficult market? Investing in a market which is rising fast or investing in a market which is doing well, anybody can do. The tough challenge is to invest in difficult markets. How many people invested at the bottom of COVID? How many people invested at the bottom of the global financial crisis? Right? We thought at COVID that the world was going to end. Genuinely unprecedented event. We thought at global financial crisis bottom that banks would shut down. So you need real conviction. So I don't think the key is to focus on risks. I think the key is to focus on as and when you will have many tragedies, unfortunately, economically going forward. This is in our generation, we have seen crisis happen every 3 years and 5 years. Earlier, you would see a crisis happening every 10 years and 15 years. So crises happen more often today, which is good news. It results in volatility. But the key is, how are you going to react? So the one thing to keep in mind is risks are perennial. Risks will change dramatically. The one thing I can guarantee you, it's a guarantee. 3 years from now, we will not be talking about AI risk. We will not be talking about US risk. There'll be a brand new risk and we will be obsessed with that risk and everybody will focus on it. And that is bound to happen and will continually happen. But as I said, the key is how we respond to when the risk plays out.
So, Taher, on the slide up there, we have the demographics of India. Hand on heart, do you feel that we can lose our demographic dividend and becomes a demographic disaster because of some of the risk that we just discussed?
Yeah, I think this some of these risks that you mentioned, particularly the ongoing risks of tariffs, AI, of course, is there. While markets do find a way to manage risks and to navigate risks, I think at some level, some of these couple of risks are basically new to us uh, compared to many of the other challenges that we have faced in the past, and therefore it perhaps merits a little more attention than we have otherwise given to other risks. And I say this simply because in the past, whenever we've been confronted with risks, at least as far as the Indian market is concerned or the Indian growth story is concerned, we have not been central to that risk. I mean, it is a consequence of whatever has been happening globally. It could be on account of geopolitics. It could be on account of the global financial crisis. So we've observed it from the sidelines to some extent. We've been affected by it, of course, but not have not been at the center of it. I think in both these cases, the current two risks, which are prominent and which are in every investor's minds, and I'm sure they will fade over a period of time. And I fully agree with Chirag that maybe 3 years down the line, they may not necessarily be the most important risks, but still we have to traverse the journey with these two simply because India is at the center of both these risks. Today, from a geopolitical or geo-economical standpoint, we are obviously disadvantaged. Things can change overnight. You might find one tweet in a few hours, and that can change India's destiny once again. But as things stand now, as we speak, I think we are a little disadvantaged as far as geoeconomics is concerned, and geopolitically too. I think we are somewhat isolated. I mean, this is the first time that India is probably at a stage where it doesn't have any friends to call out. You know, so I think that is one important difference this time around, that we are at the center of it, and we therefore need to be probably if we have to find a way through in terms of either being able to identify the right trading blocks, the right trading partners, which supply chains do you want to be part of on a longer term basis. I think those are not decisions, of course, for ordinary souls like us to make. I mean, it'll have to evolve um, at a high level. But this is something which is therefore somewhat more important and needs more attention. And same in the case with AI as well. I mean, we've had many technology waves in the past. This perhaps is not exactly only uh, restricted to India as a challenge. It is perhaps global, but still for India, perhaps in terms of uh, proportion and size of impact, could be higher simply because AI, as we all know, has the potential to actually disrupt quite a lot of jobs. It can disrupt the ability to probably create jobs or keep jobs, and that lever is a very that element, job creation and job retention, is essentially a very important element as far as India is concerned. It is perhaps true for some other large emerging economies as well, but clearly it is very relevant for us. And the other being that AI is, well, still, unfortunately, it is still in the initial phases. I mean, we've gone through about 2 or 3 years. I think it's been 3 years since ChatGPT was probably launched. And therefore, to that extent, it is definitely one can say that it is in its early stages. And it may pause for a while, but it is still going to be quite unrelenting for a reasonably decent period of time. So we'll have to overcome that hump. We'll have to see what happens over the next 3 years, because uh, hundreds of billions of dollars are being pumped into it, and they are being pumped by companies who probably will not let go of this, and they have the wherewithal to do it. I mean, all the Amazons and the Googles and the Microsofts of the world and the Nvidias of the world have got enough firepower on the balance sheet to probably continue with this over the next 3 or 5 years. So we'll have to get over that hump and assess the consequences of that. But in the meanwhile, we will therefore, like I keep saying this, that we are at a stage where we are truly Atmanirbhar today. We have to depend on our own internal levers as much as we can. This is the scenario that we are faced with, geoeconomically as well as geopolitically, in order to make sure that we are able to counter some of these challenges today.
So, sorry, I'll just add just one or two things to that. I'll talk briefly about the AI risk specifically. But what I always find interesting is this is the only market, the stock market, the only market in the world where we're happy when prices go up and we're despondent and depressed and sad when prices go down. Tomorrow, if I told you your iPhone is 20% off, your subsidies are 50% off, your laptop is 30% off, we're delighted. We're Indians. We want a bargain. We'll buy one, we'll buy two, we'll buy three. When the stock market comes down, nobody's looking for the bargain. Everybody is nervous. And the reason for that is when you buy a product, you do a lot of research, you understand it, you know the ins and the outs, what are the specifications. When we buy stocks and when we buy mutual funds, what is our understanding of these stocks? Do we have the confidence? We can't touch and feel. But the idea of buying into adversity. So the question of risk is 9 out of 10 people in this room don't want the risk to play out. So let's hope that AI doesn't disrupt things. Let's hope that the US doesn't fall apart. My view is exactly the opposite. You want the risks to play out. You want the market to correct. You want the market every once in a while to collapse, because that creates an opportunity. We will recover from every correction. We will recover from every collapse. How do we behave during the collapse and during the correction is what will separate the men from the boys and the women from the girls. So that is the key. Now on AI, I think it is a massive risk. And I'll tell you my opinion. I don't know AI beyond ChatGPT. My 13-year-old son knows more about AI than I do. But these are some of the facts. 50% of US GDP growth is driven by AI investment. 50%. 50. It is a massive number. $2.3 trillion, not billion dollars, but trillion dollars will get invested over the next 10 years. The amount of hype, every man, dog, puppy, and puppy stick is talking about AI. Yet we don't know much about AI. When there is too much excitement, the scope for disappointment is massive. It is not about AI, it is about anything else. If you believe telecom is going to change the world, you will be disappointed. Nothing is going to change the world that much. Too much interest, too much excitement, too much hype, too much market cap. It can only lead to disappointment. It would be a miracle if it didn't. Now, the question is, how will we react to that disappointment? The US economy has been on a tear for the last 7-8 years, or at least for the last 3-4 years. Stock markets have done incredibly well. Is this going to play out badly? I don't know. It is a $1 trillion question. If it doesn't play out badly, fine. If it does play out badly, and there is a temporary blip in the market, and when I say temporary, that doesn't mean just a few months, could be 6 months, could be a year, could be a little bit longer than that. You have to take advantage of that adversity, right? So I think risks will always be there. They will change. To me, the biggest event in my life probably was COVID. Right? We never thought it was a risk to our very existence. You didn't know whether we would continue. And imagine now we have forgotten about COVID. There was a point of time when the European crisis was it, right? There was a nomenclature called PIGS, right, which is Portugal, Italy, whatever, Greece and Spain. We don't talk about that anymore. We will move beyond this as well. In the interim, if it causes a massive correction, it's a tremendous opportunity.
Thanks. Slightly divergent views. You're saying that it could be the same as the last time, but you are saying that it's a little different this time, right? On the same lines, let's say if that's the case, both of you at least acknowledge that's the risk. Chirag, you are saying that time will hold you through, and if you, let's say, stay invested for 3 years, you should be able to sail through because you'll have these risks behind you and something new will emerge. I just want to understand from you that if somebody wants to stay invested for 3 years, but these stories keep haunting them, one is how to keep mental peace during these 3 years, and second is how to construct the portfolio, or at least how you are constructing the portfolio to mitigate these risks.
So, well, there are some differences or nuances which we probably this time around we might have to do things a little differently compared to the past. But otherwise, the tried and tested formula in times when you're going through a crisis which is not fully under your grasp, as Chirag said, many of us beyond a particular point don't understand what AI is all about. And that's absolutely true. So I think in those circumstances, you only try to do what is within your grasp and what you probably understand the best. So that's one, that you increase your exposures to those companies where you probably have a better handle about the way the business is probably going to unfold, and you have better clarity, and you are able to visualize that okay, there's going to be continuity of growth, earnings that you want to probably see. The other tool that we obviously deploy is try and diversify. I think it's a little challenging. It's become a little more challenging now compared to, let's say, when we emerged out of COVID. When we emerged out of COVID, we had a crisis behind us, but at that time too, the portfolios needed a certain way of being managed. But the good part is that the market was broadening at that point in time, so number of opportunities were also expanding. And obviously the broader market, as we all know, in the last 3-4 years has done far better than, let's say, the narrower market as defined by the Nifty. But this time around, we have a somewhat different constraint that we're not exactly in a crisis, but we have these couple of challenges which have been around for us. But the market is somewhat entering a narrower phase. So that basically means that we are left with a somewhat narrower set of opportunities than what we had in the last 3-4 years, and that's why. And then to bring diversity in the portfolio becomes a little more challenging, because when markets are broadening and if we want to diversify, it's much easier. But if it is going the other way, and if you want to try and diversify your risks across the portfolio, it is a little more difficult. But nonetheless, diversity is the answer to that risk, to any kind of risk for that matter. I think the way we are probably doing it is diversify across themes, across sectors, maybe more preference for domestic stories compared to, or domestic opportunities compared to, let's say, global opportunities. Certain specific global opportunities which India can probably be part of as an extension, or as a you know indirect beneficiary of uh, AI or tariffs. So some of those choices that we can probably make and try and make the portfolio a lot more stronger and more diversified. So I think this is the way we basically can navigate the uh, current environment that we can probably that we see in front of us.
Got it. So sit for the long term, diversify your portfolio. Those are the two things. Risk in a way is good. That's what drives the reward. Is what we hear from you. Tahir, we heard your views on some of the growth areas. Chirag would like to pick your mind on this thing. Last 2 decades, let's say from 2005 to 2025, discretionary consumption and financials have contributed meaningfully to EPS. Going forward the next 22 years, maybe a long time horizon, but which sectors do you think could be the contributors to the growth
In the next few years? Is that the question?
Yeah.
So my answer is going to be a little bit different. We are very stock specific in the way in which we create our portfolios. In every sector, there are stocks that we like and we don't like. Even in sectors that we really don't like, we will find companies that we do, and vice versa. There are plenty of sectors that we love, but lots of companies that we don't like. That will depend on the management of the company, that will depend on the business model, that will be dependent on the valuations, and so on and so forth. The one interesting thing, though, is that the market goes through a lot of what we call rotation. So what is rotation? Right? It changes. The market's preferences change. It will like one thing for a period of time and then it will rotate to something else. So if we see rotation in many forms, right? The most obvious rotation is sector rotation. ABC sector does well, then it slows down from a market standpoint, and then XYZ sector does well. So the market rotates from a sector standpoint. The market also rotates from a market cap standpoint. Right now, everybody's obsessed with mid cap and small cap. There was a time when we were obsessed with large caps. Large cap, mid cap, large cap, mid cap. The market also rotates in that fashion. And lastly, the market also rotates in style, right? This growth versus value. Neither of them is a good word or a bad word. There'll be a point of time when the market is obsessed with growth, then it's value, then it's growth, and then it's value. So the key for those who are short-term investors is to figure out the turning point, right? When does growth become value? When does X sector become A sector, and so on and so forth? But if you're a long-term investor, right, you have to pick companies and just hold on for an extended period of time as long as the basic nature of that company is not changing. Now, the last few years have been by and large dominated by investment related themes, right? It's not only investment, pharma has done well, IT has done well, but I think the way forward, we are a little bit more optimistic on the consumption theme versus the investment theme. Now, to me, this is still a lot of CEO speak and jargon. Within the consumption theme, there is still things that we don't like. Within the investment theme, which we're getting a little bit more concerned about, there's still things that we like. So for me, it comes down a lot to being stock specific. But rotation is something which you must always keep in mind. Something which is done extremely well will slow down. And things which have been neglected and have done extremely badly will pick up. That has been true for the last 100 years in stock markets.
Great. The last question, not related to markets, but the mutual fund industry rather. So over the past 22 years, we've seen in 2003, the industry was at 1.21 lakh crores of AUM. Today, one single flexi cap fund has an AUM greater than that. Next 22 years, by 2047, what's your view? Would like to hear both of you on that.
We have difficulty figuring out what is going to happen next week and next month. And the question is to what is going to happen 22 years later. Actually, interestingly enough, it is far harder to predict what is going to happen 1 week later, then 1 month later, then 1 year later. So if you ask me what is going to happen to the stock market in this year, the cameraman, myself, the guy who receives you at the door, all our opinions are equally valid. We don't know. You might as well flip a coin. Nobody knows. You go to a 3-year and 5-year perspective, we are a little bit more confident, right? Because now good news and bad news will even out. You go to a 10-year and 15-year perspective, you come to a degree of certainty, right? If you invest for 15 years, you will do very well. If you invest for 1 year, I don't know. If you just invest for 3-5 years. So the key, I keep saying the key, and go back, so it's a little different. It's not exactly answering your question. Will the mutual fund industry will continue to grow? Assets will continue to grow. Right? There'll be some hiccups along the way. What's going to happen over the next 22 years? This industry will grow by leaps and bounds, right? It's bound to happen because it's the passage of time, right? We'll have some years where there'll be zero growth, and then we'll have years with 50% growth, and then eventually the CAGR will always be a reasonable one over a longer period of time. The key in all of this is to invest for the long term. Long term gives you predictability. I'm just going to digress just for 1 minute. The two mistakes that people make in stock markets, there are only two big mistakes. The first mistake is investing when things are very high. And the other mistake is selling when things are very low. Both those mistakes, even if hopefully you don't do both of them simultaneously, but either of those mistakes, if you invest for the long term, will still mitigate that mistake. What does that mean? Even if you sell at the bottom, but you've held for a long period of time, your returns will still be good. Even if you bought expensive, but you held for a long period of time, your returns will still be good. For those who invested at the top of the IT bubble, which was a bubble, it was a massive bubble, you still made close to double-digit returns, but it took 15, 18 years, right? But you still did well from what was a ridiculous point of investing. And I can give you examples of people who've sold at the bottom, right? I'll give a personal example. In our family, Hindustan Lever was a large investment. My dad sold at the bottom. Stock went 7x. But I gave him the consolation that even after selling at the bottom, his returns were fantastic because he was an IPO investor in Hindustan Lever. So the key in this business, it is not about listening to us. It is about listening to yourselves and investing for the long term. Get your asset allocation right, keep investing for the long term, and buy into adversity. And then all of this is interesting to look at, but this is the key. So I don't think I've answered the question exactly, but
Right. Here's my perspective. Taher, please.
Well, of course, undoubtedly the market will grow. The mutual fund industry will grow. It will obviously be substantially larger than what we are today. I think we are closing in on $1 trillion in terms of AUMs, out of which $500 billion is probably equity AUM, a little give or take. And I think this number, $1 trillion, will probably be 20x of what we are today, probably by 2047. I wish we all can see that. We are around to see that number. But I think that the internals of the industry will change as well. I mean, I don't really think it'll be the same plain vanilla mutual funds the way we have it today. There will be a lot more complexity. There will be, I think, we will probably have many more international overlays. I think we'll have to, all of us, I think, at least myself, I can speak for myself, that I'll have to learn a lot about what other markets are all about. How do we manage multi-asset type of products? Those are going to be important elements of the investor mix, of the investment mix. Those are going to be the things that investors like you will probably demand from us, and we'll have to be prepared for that, both in terms of being able to deliver, design those products, as well as run those products and manage those products. So I think in that sense, it will be far more evolved. It will be a lot more sophisticated. It'll also be a lot more complicated. And that is where the challenge will also lie. I would like to think that out of my 30 years of industry experience, probably, at least 15 odd years have gone uh, in a time when the industry has been relatively more simple and easy to understand and grasp. But I think complexity will probably only rise as we go along, and we'll have to prepare ourselves for that.
And the passive part of the business will become a lot more important, right? Today, we are in this 80-20. I'm not sure where that number will settle, but the industry will grow, right? We'll double every 6 years. That's, the kind of compounding you would expect at 12%. But you will see more complexity, which is what Taher mentioned. You will see a lot more passive funds. We live in interesting times.
Any scope of the third chair being there for a bot after 22 years?
Sorry.
A bot replacing the fund managers after 22 years.
For a long time, and I believe in this to some extent, people always said a monkey can replace a fund manager, right? You can take a newspaper and take darts and throw it at it. So, and there is a lot of truth in that, because there is a lot of luck in our business as well, right? And we have to try really hard. And very often skill and luck is confused. So sometimes I feel the monkey can replace a fund manager. Sometimes you feel that the AI robot can replace the fund manager. So I think the key message in this is the fund manager is can be replaced possibly over a period of time. But the interesting part is this is not a business about intelligence, right? Having done this for 15, 20 years, the smartest guy in the room is usually not the smartest investor, 8 or 10 times. The best investor is the guy with good character. What does that mean? The ability to be contrarian, the ability to think long term, the ability to not get distracted, the ability to question, and so on and so forth. And I don't think beyond a point the monkey has it, and I don't think beyond a point the AI robot has it. But the truth is, as far as human beings go, only 3 out of 10 human beings have that good investment character. I think whatever success I've had in this industry, it's got zero to do with intelligence. It's got not much to do with hard work. It's got a lot to do with having the right character, being patient, being long-term, all of those things. So I still feel the fund manager will have a big role to play because of these reasons. But it's not, I don't think that easily replaced.
Your views?
Well, again, things will definitely change. Nothing remains the same forever, right? So we've been used to a certain style. We've been used to a way of doing things. There will be some things which will remain permanent. So Chirag alluded to that, and definitely temperament is temperament, psychology, character. That is something which will probably not change. That will be an integral part. But then we will have to adapt ourselves to newer technologies, newer tools. I'm sure we'll have to. I'm trying to set a goal for my own self that I should learn a few AI tools by the end of calendar year 26, so that at least get familiar and probably I'm able to give some more intelligent answers in front of an audience like you. But I think that's something which I'm making myself a personal promise. So I think that will come as part of the play and the package. We may not be able to um, deny it beyond a particular point. They will have to be used intelligently. I think it will be a mix of using the passive, those tools along with our existing, abilities. We will have to ensure that we develop good risk mechanisms. We will have many more, diverse AI tools, but we'll have to try and see how do we filter the best out of them. We will have to probably ensure certain levels of governance around it as well, in order to make sure that they are robust enough to be able to, because everything in AI is not going to be the gospel truth. AI is known to fail, so we'll have to test that over a period of time. But I think industry will have to absorb, imbibe some of these tools. Definitely, it may not be the next 3 years, but I'm sure it's not a very distant reality either. So there will be some of these things which will change. As I said, that we will have to equip ourselves to handle some of the newer products. We talked about passives. There is this whole new thing about SIFs, within which and India is known to have been a unidirectional, long-only market for all this while. As global participation keeps increasing and we convert ourselves into a far more integrated global market, it will become a two-way market in which we will have to once again develop those skill sets. A very small sliver of the fund management community, in my opinion, probably has that ability at this stage. So we will have to inculcate new talent as it comes along. I think we are a 30, 35-year, 40-year-old mutual fund industry, give or take. It's not very old. It's not too young either. But 40 years is a good time for generational shifts to happen. And I think a generational shift probably, we are in the midst of that generational change. I think we've seen some very smart investors who have been part of the industry, stalwarts, very well-known names who have been part of the industry for a very long time, but have handed over the baton now to others. So there is a new generation which is coming in. They need to be equipped. They need to go through the cycles of investing. I think we have to induct talent, groom talent. Those are the challenges that we as an industry, the mutual fund industry, are facing. Probably will have to face, and those also will be the challenges of growth. So while we aspire to that number in 2047, but alongside will have to also prepare ourselves or equip ourselves to be able to handle those massive sums of money that investors will entrust us with.
And let me just a little bit add to that. The life of the fund manager is going to get harder, right? I remember when I joined this industry, it used to take 1 month to get delivery of your shares. 1 month, right? There were no quarterly results. They didn't exist. There were no con calls or hardly any con calls. And now companies with 500 and 1,000 crores market cap hold plant visits and conference calls at 50 and 100 analysts following companies and so on. So the life of the fund manager and active management is becoming harder as the years go by. We are all trying to generate excess returns, alpha. And that alpha comes from three sources. It comes from informational advantage, which is now called insight trading, right? And it's not just that I say that lightly, but having superior information. I think those days that's very difficult now to achieve. To get superior information, you really have to go out and meet the system around a company, distributors, suppliers, wholesalers, and even that everybody is doing. So informational advantage is gone or almost gone. Then you have the analytical advantage. I can analyze something better than the next person. There's so many smart people out there. The analytical advantage is also more or less gone. The third form of advantage is character advantage. That is, I am steadier, I think longer, my behavioral mindset is better than others. That advantage has gone up because we are in an environment, a gig economy where everybody's short-term in nature, everybody's greedy in their orientation. So if you're steady with good character, that's your big advantage. So I go back to what I may have alluded to in other answers. It's not about having the right information or being the smartest guy or the best analyst. As a fund manager, increasingly what's important is to have the right approach, character, systems, processes, and fund houses which are supportive.
And I'll just add to this that maybe Chirag did not probably mention this, but he wanted to go down that path, I'm sure. That therefore, from an investor standpoint, I think we will have to probably look at kind of moderating our return expectations or alpha generation expectations, if not return expectations, because information is more freely available. I think there is a massive community of new investors which has got added into the system, as we all know, over the last 3-4 years, and that basically means that there are more participants. More participants means less information arbitrage to be able to kind of take advantage of. So maybe the mechanism to probably then generate alpha or do better than your neighbor would probably be by designing of the portfolio. The portfolio design will probably matter a lot versus only idea generation, because and that is where your character, your temperament, your conviction, all that will come into play, because how much are you able to allocate to a particular idea? Can you put a 5% position on the table? Have you been able to generate that kind of a conviction versus your next best peer or competitor? That is probably will differentiate one portfolio from another. So I think And that is where, portfolio construction is an area which I think, from my limited understanding, is a place where a lot of these newer tools, AI included, will probably be of great assistance. It may not necessarily do as much in terms of being able to identify ideas, because beyond the point, uh, you need to understand management competence, management's hunger for growth, along with hunger for growth, balance of risk and temperament of the promoters as well. So I think those are softer aspects which may not necessarily be captured through technology, but I think technology can be a great tool in terms of being able to design different kinds of portfolios under different circumstances, different conditions. You talked about how can we design a portfolio which is relatively AI proof or tariff proof at this stage. Some of these things we will have a lot more assistance out of technology as we go along.
Great. So just to summarize, the opportunity is long. We have a $30 trillion economy in front of us. Uh, there will be short-term risks. They might not be visible after 3 years. And the way to tackle them is through diversification and long-term horizon. Um, in terms of stock picking, etc., things like sector rotation and stock picking should be able to generate alpha. And the industry, mutual fund industry itself, will see a lot of disruption and evolution going forward, is what I hear from you. Uh, Yash, do we have a few minutes for a couple of questions? Sure. We can open the floor. We have a gentleman here.
Good evening, Chirag. Good evening, Taher.
Say, if you can be a little louder, we do not have a feedback.
Hello.
Yeah,
Yeah.
thanks.
Good evening, Chirag. Good evening, Taher. My question is related to index funds. Over the last many years, I keep reading that most mutual fund managers are unable to beat, and says 80% of the mutual funds are unable to beat index funds, especially in the long run. And you've been talking about the long run. How does an investor then choose a mutual fund in these difficult times when there's already dilemma over so many things, and with these kind of index fund being able to beat mutual funds at all at 80% of the time? Any ideas on that? Both of you.
My please.
So I don't think we are here only to give answers. We are here also to help you just think about things. So let me just put a few thoughts across. So this is this debate about active versus passive management, right? That index funds will beat active managers. So what happens is the active managers turn around and say that, you know what, that's not going to happen. India is a market of 3,000 companies. Active is the way to go. The passives turn around and say, it doesn't happen. You guys don't outperform. Passive is the way to go. I think the reality is somewhere in the middle, right? Active management, so the ability to generate excess returns, I think is here to stay, but the importance is coming down. It's getting harder and harder. I can see that in my own career. With so much more competition, gone is the information advantage, gone is the analytical advantage. It's going to get harder and harder. In the US, you generate 1% alpha, you're considered to be stellar. In India, 1% is low, right? You want 3-4%, but over a period of time, that 3-4 will come down. I think both parts should be included in your portfolio. You must have an active part of your portfolio. You must also have a passive part of the portfolio. Both are important to have. There'll be periods of time when the index is very easy to beat. And there are periods of time when the index is very hard to beat. And I'll give you an example. This is true. This is not a story. I remember 5-6 years ago, I went in at the end of the year in April for my evaluation to Prashant, who was my boss. And my funds had done very well. And I was expecting to be paid handsomely. And he turned around and said, nothing doing. This year, 98% of mutual funds have beaten the benchmark. Oh, what's the big deal that you've done? So I put my tail between my legs and went back. The next year, right after that, performance was not so good. So this time I went in with my tail between my legs, expecting to hear that, not a good job, etc. And it was exactly the opposite. Because in that year, 80% of mutual funds had underperformed the benchmark and relatively had done a lot better. When the index performance is concentrated, sometimes it's very, very hard to beat the benchmark. Because we have heavyweights in the index, Reliance, TCS, HDFC Bank. If one or two of these do spectacularly well, as an industry, we all typically do badly. When it is broad-based, when mid-caps, small-caps participate, it's a little bit easier. So even this comes and goes, right? There is no simple answer to this. There'll be points of time when our funds will outperform, points of time when our funds will underperform. Now, rather than trying to pick the fund which is always going to outperform, which is hard, keep a balanced portfolio, right? Keep 20, 30, 40% in passives and 50, 60% in actives. And then if you see consistent underperformance, then you have people like Dezerv who can guide you. Say that, you know what, things have changed at a fund level or a fund house level, and we advocate that you shift to something else. So I think that's the best answer I can give you. But in general, over a period of time, the importance of passives will go up. It has happened in the US. It has happened in every developed market. We will also follow that path, whether we like it or not.
Maybe I'll just supplement by saying that yes, absolutely, the passive market will grow. Whether it will overtake actives, I don't really think that is the very near-term possibility. It will take probably a few decades before we get to that. I know of many, developed markets also which are actually generating as much of alpha as India as an emerging market is. So clearly, we have a long way to go. But I think the other one metric that you can probably use to see how do you bring in passive funds, or how do you identify passive versus active, is that maybe I would think that if you're doing, let's say, index or rather something like large cap funds, which are more index centric at one level, then probably it makes sense to do it through an index fund itself. Why do you want to pay an extra cost in order to returns get returns which are going to not be very significantly different from what an index fund or a actual fund will probably deliver. Index fund will also probably deliver the same. When you're looking at when you have decided on taking a somewhat higher level of risk, and you attuned yourself to a higher level of risk, and I'm talking therefore about mid cap funds or small cap funds, I think there it probably makes sense to take bets with active fund managers instead of probably looking at passive funds, because you will then have that finesse or track record or individual brilliance come into play in terms of stock picking, and which probably will help you generate that extra alpha. Of course, it will come at a risk. So I'm therefore assuming that you are in any case prepared to take a certain high level of risk when you get into mid caps and small caps as an asset class. So when you come to that, I think you can probably prefer more of the active fund managers. You can, with the help of your advisors, but and otherwise you can probably look at more passive funds in case of more frontline index or large cap oriented, similar to large cap oriented funds. That's one way of probably differentiating things in your mind.
Hello, good evening. Good evening, Pratik, Chirag, and Taher. I'm Mukund. My question is that I have invested in several schemes across top 5, 6 AMCs. And my observation is that even if it is for 8 years, 10 years, XIRR is only around 12%, 12.5. Why so? Why, like you say, stay invested for long term, then it should be higher than 12%. If I'm for long term, like 8, 10, 12 years. And this must be the observation of many of us.
Sure, thanks. So I'll just put that. So he's saying that over an average XIRR, why is it just 12%? That's his experience of 10 years of investment in mutual funds. Any comments, any one of you? Taher?
On the face of it, of course, even at 12% at a blended basis I would not qualify as a subpar return. It's a reasonably decent double-digit return, especially compared to risk-free, or probably even if you were to look at the index, I think you would have then even still beaten the index by a couple of hundred basis points. But the point is that we don't know what is the configuration of your funds. You said you had a family of different mutual funds in that. So I think the composition will matter in terms of we know that there are different asset classes which perform with different intensity. So your 12% would be great with corresponding to the risk that you have probably taken. It would not be commensurate if at all the risk has been higher. So if you have done more of the mid cap and small cap funds and yet you have ended up with a 12% return, it will be quite it's something that one needs to evaluate. but it will depend a lot on the composition, which we need to probably study before any one of us will be able to offer an opinion. But that is where probably.
I would just a few things to add to that. One is your long-term return expectations should be 12 to 15%. The economy is growing at 11-12%. You can assume that earnings will grow at 13 to 15%. Our returns are going to be 13-15%. The average Indian investor is far greedier than that, but that doesn't mean anything. You may want 18 and 20% returns, but the fact is, over a longer period of time, 13 to 15% is the right number. You can have periods of 10 years where you get 18%. Those are exceptionally good years. You can also have 10 years where return can be 7-8%, and those are exceptionally bad years. But over an extended period of time, 13 to 15% is the right kind of return to have. How do you enhance that return? You enhance that return by not only investing at a point of time, but investing systematically, so you get good times and you get bad times. And you every once in a while need to put in a lump sum. The problem with SIP thought process is it has made investors feel as long as I do SIP, that can be my entire strategy, right? Just do SIP, fill and forget. That is largely true, but it leaves out the lump sum element. Every once in a while, we need to put lump sums in. And when do you put a lump sum is very easy. You put lump sums in when times are really tough. When everybody says this is a terrible time to invest in the stock market is a casino, nothing is happening, there's bad news, you put on CNBC and everybody's crying, that's the time to put serious money in a lump sum fashion. So 12 to 15%, I think, is a reasonable expectation over a longer period of time. If you want to enhance that every once in a while, you need to go out and be a little bit contrarian.